they told her, you need to stop. You need to absolutely stop. You need to stop, period. And they were like, she was like, no, she kept drinking. And so 2 years after that, yeah. And then 2 years after that, she got diagnosed with
Good morning.
And I'm saving my money. So, do any of you have any questions? With respect to these 4 weeks, because I'm finding it very interesting. I'm finding it interesting based on your feedback, not as far as much as what I'm saying, but as far as the feedback that I'm getting from you. Very interesting, very, very interesting. So, having said that, I'm going to introduce our new guest. She's been in banking for 28 years, and she is a colleague of Miss Nancy, and she joins us. She does a lot of neighborhood development. Uh, she works with the Ohio Community Reinvestment Corporation. Um, Her territory, I wanted to kind of summarize it, but her territory not only is Nevada, but she's also responsible for Idaho, Montana, Arizona, New Mexico, Utah, and Wyoming. So she has a pretty broad scope, and she's taking the time out to spend with us. So I want us to give Miss Jane Pavic a good welcome, and I welcome you, Jane. Come on, everybody, give her a good welcome. Come on, everybody, let's go, let's go.
Good morning.
Good morning.
Thank you, Daryl.
You are so welcome.
Did you want to add any further comments or share any wisdom this morning?
No, I just kind of go with the flow.
Okay.
And a lot of times in a dialogue, things come up in my mind, and I just want to share it with the youth that we have here uh, uh, on this Zoom call. And one of the main things, since Jane asked that and it just popped up, Jane, myself, I'm speaking for Jane, and Rhonda, we want you to know we remember when we were 17, 18 years old. So don't look at us as old curmudgeons. We remember where we came from. And we're going to get you where we are with less mistakes. Take it away, Jane.
Yeah, great. Thank you. And I really appreciate you guys making time this morning to be here. Giselle was talking about the week that he's had, and that apparently with school and some of the grades are being closed out this week. So that's got to be stressful. But I think just showing up to this shows me that you guys have what it takes to be successful in what you want to do. So as we talk through our topic, I will say that Nancy probably had a really good routine down. I'm going to try to fumble through this, so just give me grace. I don't have a big ego. So if don't be afraid to laugh if I do something that I shouldn't be doing. I appreciate that feedback. So thank you very much. And I'm glad we're spending Saturday morning together. Rhonda, are you going to be running the lesson now? Or I do have a couple questions for the group.
No, actually, I've given you co-host so you can show your screen. You take it from here. It's all yours. You can
Okay,
share
so
your
are
screen
you-
and everything.
So I need to pull up the hands-on banking website then. Is that
Yes.
correct?
Yes.
Okay, let me pull that up. I'm sorry. So I understand that most of you have a savings account. Is that correct? I see some head bobs. Just
I
some of,
I
Say-
do. I
Say
do.
yes. Wave your hand and say yes. If you have opened up a savings or checking account already, wave your hand and say yes.
okay, I see some. So do any of you want to talk about that experience when you opened the savings account, or want to share with the group what it was like? What questions you had as you pulled that up? Or as you opened the account, I should say. Daryl, Rhonda, do you want to talk about the first time you opened an account? Why I pulled this?
Well, I walked into the bank with Jesus Christ, so that's a long time ago. My account number was 2. No, it was a long, long time ago. And I tell you the truth, I opened my first bank account all by myself. I was very nervous because I didn't know what to expect. I remember like yesterday, the bank was a little structured a little differently. Again, I'm from New York City, and the banks were in New York City were built like cathedrals. I mean, with marble pillars and marble floors. And I went in there and I opened up an account. Matter of fact, it was a Christmas account. I wanted to put money aside, so I had money for Christmas. And I think I had to save like $5 a week or something like that, so I could have some money for Christmas. And that's what I remember.
So for me, let's see. So give me 1 second to get back to you all. I was sending an email to the rest of your classmates. So basically, yes, I have a personal checking and savings account. Much like Daryl, I've had one for many years. And I also have a business checking and savings account because I'm an entrepreneur and I own my own business. And now, because of the way of the world is, when you go in to open up your business account, well, when you go in to open up your personal account, if you don't already have one, you would go in for you, if you have a state ID or a high school ID and your birth certificate, those would be the things that you would use to go into the bank to open up a savings or checking account at your age. You would have to have a driver's license if you were old enough to drive. And some of you might be old enough to drive. So actually, if you have a driver's license, you would use your driver's license. So you could use your driver's license or your Nevada state ID to go in to open up a bank account along with your birth certificate and your social security number, because they'll ask you for your social security number because you have to give that documentation. And you could go in, if you don't already have a bank account, you could go in with your parents or one of your parents, mother or father, or any adult. You could take you into a bank and open up a particular account. I think as a student, for student accounts, you probably need to have about $25 to open up your account. As a business account, if you were an entrepreneur and starting like a t-shirt business or something like that, you would need $100 to open up a bank account. So $100 for business, $25 for personal. Now, because of COVID, if you haven't already opened up a bank account, you have to make an appointment to go in. So you would call the bank in advance and you would say, "Hi, my name is Braylon Adams. I'd like to set up an appointment to see a banker today to open up an account." And they'll say, "Which type of account, personal or business?" And you'll say, "I want to open up a personal savings account." And they're like, "Okay." And then they'll give you a day and time to come in, with your parent or by yourself if you're 18 to open up that account. Now you always want to keep your accounts in good standings. And I know I don't know if we talked about this before, but you always want to keep your account in good standing. And I also want to remind you, in this program, during this 7-week process, whatever money you save in your checking account, we're going to match up to $200. So hopefully you have been putting the money in your account. And so when the class is over, I'm going to say, may I see a copy of your account so I can see how much money you put in during this 7-week process. And then we're going to match that. And we're going to give you a check to match that so you can put that money in your savings account. Does everybody like that?
Yeah.
All right.
That is,
Did everybody know that? Everybody knew that? Okay.
yeah. So, I mean, what a great, thank you, Rhonda, for sharing that. And, you know, it's almost like you're getting paid to attend these classes, which is a huge opportunity. A lot of people don't get that opportunity. So good for you. And, you know, so I guess I should explain, in my role, I don't open accounts. I actually opened accounts when I first started years ago. So used to do that, but in our role, we don't open accounts and we don't make loans, but we help people get to the right people who are going to help them open their accounts. And next week, I will have a branch manager. So someone who runs the branches, she'll be here, and one of her bankers, and they'll be able to answer like any technical questions you have. Like Rhonda just went through how you go about opening an account, a savings or a checking account. And of course, we're talking from Wells Fargo's viewpoint, but know that the process to open an account, checking or savings, is similar at all of the banks that are in your town, even within credit unions as well. We're all here to help you keep your money safe and to help you earn more money on your money, which is what we're going to talk about with savings today. So, and you know, Daryl and Rhonda shared their stories about when they first opened their account. You know, we all started somewhere. When I was really little, my parents actually took me in and opened a savings account. And at the time, this was years ago, I think I maybe had $1 that my grandma gave me for my birthday present. But I put it in there, and every year she would give me this amount. So one thing to keep in mind, it may seem like you're making little steps, taking little steps, but before you know it, you're going to be running a mile. So it takes time. Be patient with yourself, but know that you'll be able to set your goals when it comes to your money and reach your goals that you want. So there's so many different topics to talk about this week when it comes to savings account. Does anybody have any questions or so far, or want to add to, you know, share your stories? Okay, I am going to, so Rhonda, I'm going to pull up my screen.
Okay.
You all need to let me know when you see, can you guys see the course now?
Nope.
No. Okay. How about now?
Yes.
Fantastic. Okay. And that is the wrong screen. I am so sorry. I had it queued up on the, we'll just start over then. And, you know, I will say, so Rhonda was talking about going into a branch, but with COVID and the way technology is, there are lots of different ways that you can access accounts and schedule appointments to go in and open your account online. So most banks and financial institutions and credit unions, they have, once you get your account open, they have apps so that you can track your money, you can make deposits from your phone. And I am not an expert on that, which is why I wanted to let you know that next week you will have someone here who can walk you through that. So just wanted you guys to know that, because I know that most of you probably are much more comfortable with your phones than you are walking into a branch, maybe. And you know, another thing is, if you just wanted to go in with you and your friends, or with your parents, or your brothers, sisters, your siblings, I could help you arrange a personal tour of a branch, if that's something that you guys would like to do in the future. And then you could just get a feel for what it's like and Most branches are pretty similar. So with that, I'm going to just dive into our savings lesson today. Any questions? So this is open forum. You guys just interrupt me. Start course. So rewarding yourself. I think that's one thing that you need to think about when you think about savings, is that you are rewarding yourself and you're paying yourself like you are with this class. So I'm going to go ahead and just play this. Can everybody see it on your end?
Yes.
I used to think someday I want to have my
Jane, I can't hear a thing.
I'm sorry?
I can't hear a thing.
You can. Do I need to do something special on this side?
Rhonda, can you hear it?
Just turn your volume up a little bit. I heard the beginning, but then I couldn't hear anything. I think
Yeah.
if you turn your volume up, we might be able to hear it.
Okay, I just did that. I apologize. Let's start
Okay.
over.
Oh, on your screen, Jane, when you shared your screen, did it ask you to share this volume as well?
No, it did not.
Okay, you come out of share screen. I'll come in and I'll put this up. And I think I can do this. Let's see.
Okay, stop sharing. Hold on. I apologize.
It's okay.
I used to think someday I want to have lots of money. But now I know there's a big difference between having money and building wealth. Money's something that goes in your pocket and comes right back out. But wealth is things like savings and investments, property, a business of your own. Those kinds of resources give you options and let you take advantage of opportunities in life. If you're earning money, what are you doing to reward yourself? We'll show you how to save and invest to build wealth.
Great. Thank you, Rhonda. So let's talk about that. Can you hear me?
Yes.
Okay, great. Yeah. So let's talk about that. Investing and savings. There's a difference between those two terms, and rewarding yourself. So one important thing you need to think about is you're spending your time. If you do have a part-time job, maybe you're babysitting, maybe you're working, at a store, retail store. You're spending your time. You're getting a paycheck, and you may have bills already. You may have to pay things like gas or a bus pass or your cell phone. So you do need to pay your bills, but the most important thing that you should do first and foremost is pay yourself. And that you can do that through savings and a savings account. So if you look at the target timeline, these are some steps that you can take on your to-do list to further your ability to save, to reward yourself, to plan for your future and the goals that you want to reach, whether it's something you want to do in 6 months or whether it's something that you want to do in 3 years, 5 years. Maybe some of you are looking at going to college. Maybe some of you are looking at wanting to buy a car. So one of the first steps is to open a savings account. So we kind of touched on that. The second step is to commit to a monthly savings goal. And this can be a percentage of what you earn. It could be a certain amount each month. Maybe if you are babysitting, it's not something that's on a regular basis, or, that you're not certain about how much money you're going to get each week or each month. So then if you just take a certain percentage or, a certain dollar amount, and it doesn't have to be, it can be whatever you feel comfortable with, and also allows you to still pay your bills. So, but think of it as you're rewarding yourself You're paying yourself for the time that you spent doing that activity that helped you earn the money. Does anybody have any questions or want to add to that about thinking about it in that terms?
Yeah, I want to express to the young folks on here, when you pay yourself, you got to set that money aside, because many of us, me included, we spend what we have. If you pay yourself and set that money aside, you will budget the rest of the money for the rest of the month, rest of the week, rest of the day. So I like what Miss Jane is saying. Pay yourself first, and then continue with the rest of your money.
Yeah, thank you, Daryl. I mean, I think you guys are important enough. I mean, you guys are important. You deserve this, and you should feel good about it. So, talking about opening a savings account and what are the benefits of doing that. When you have a savings account at a bank or a credit union, your money is safe. You don't have to walk around with a bunch of money in your pocket or in your house. It's not going to, if something were to happen to your house, your money will be safe in your savings account. In a savings account, you do earn interest, which we'll get into in a little bit as well. And again, it does help you prepare for the future, helps you prepare for unexpected expenses, and to make larger purchases. So there's really some real benefits about opening a savings account. So with this list, I'm just going to read through. I want you to think about the potential. When you open your savings account, then you commit to a monthly savings goal. The best way to maybe reach that goal is to automatically transfer amount into your savings account. As you earn more money, you can increase the amount of money that you save, or you can if you have bills that you need to make sure that you're paying, you can also devote more to maybe paying off bills. And eventually you'll get to the point where you'll contribute to a retirement plan, like Nancy. She retired, but she worked for the bank for, I want to say, at least 30 years. And you also, there are other things that you want to keep in mind as you're earning money and budgeting and making decisions around savings. And part of that is the bills that you have to pay on a monthly basis. And when you graduate, leave home, you'll have your own apartment, you'll have lots of expenses that go into living on your own. And hopefully the information that you'll be getting through this class will help set you up so that you'll be in a good position to meet all the bills that you have to pay. So Rhonda, do you want to keep going down through the lesson?
Well, let me interject while Rhonda is moving the screen. A lot of times the difficulty of savings, we all say, I don't have it. Last week I asked you, how much would you have at the end of the year if you saved a nickel a day and added a nickel? Did anybody resolve that problem? Just saving a nickel a day and adding a nickel. Well, you would have $3,300 and more dollars. 3,000, just saving a nickel, then 10 cents, then 15 cents. A lot of times it's, I need to save 3,000 and you can't get there. But if you just save a nickel a day, you can get there.
Right. That's exactly right. It doesn't matter how much that you're doing it, it's that you're doing it. And maybe you every week at least go and get one sort of drink at the store. You should ask yourself, do you really need that specialized? Maybe it's a coffee at Starbucks or something like that. Ask yourself if you really need it. If you take that money instead and put it in your savings account, over time, you're going to end up with quite a bit of money. If you did, $4 every month, that's $50. So that's a lot of money. And on top of that, you get interest. Basically, the bank pays you money to keep your money in the bank. If that makes sense. That's what interest basically is. So the most important step is to say, I'm going to do this, and then put whatever amount that you feel comfortable in and that makes sense for your situation. So we have a scenario, and this is Randy. So I'm going to go ahead and read through this. This might help us to talk more about increasing savings and the best way to do that, the easiest way to do it. So Randy's making money, paying bills and buying stuff, but sometimes runs short between paychecks. She doesn't like feeling broke. She wants to get into the habit of saving so that she has money to fall back on if she loses her job or has an emergency. She also wants to save up for big purchases, like a vacation trip. In the long run, she wants something to show for her hard work and to be able to retire someday. So there's a lot of goals that she's gotten there. She doesn't like feeling broke. I don't think any of us like that feeling. She runs short in between paychecks, and so she's trying to figure out how not to do that. She wants to get into the habit of saving, and she wants to have money to fall back on if there's an emergency. So like maybe she has a car and her car breaks down and she needs to get that fixed. And then also saving up for big purchases. So maybe she eventually wants to buy a new car. So she's got a bunch of different goals in there, as well as saving for retirement. So let's see what choices Randy has and see what you think would be best. So given her situation, which choice do you think is best? The first one is to make savings her number one priority. Set a goal and calculate an amount to save every month, no matter what. That's your first choice. Second choice, put any extra money she receives, such as tax refunds, a bonus, a raise, a gift, into her savings. And then the choice number 3, automatically deposit a percentage of her income, for example, 5-10% into her savings account. So if she makes $200 a week, putting 5% of that would be, somebody keep me honest on that, $10. Does that sound right?
Yeah.
Okay. Thank you. I don't have a calculator, so wouldn't in front of me. So who thinks that making savings her number one priority, the first choice, set a goal and calculate an amount to save every month, no matter what, is a good choice? You want to raise your hand if you think that would be what you would do?
Anyone?
You can answer in the chat, people. You can answer in the chat.
Yes, and yes, if you don't want to turn your mic on, answer in the chat if you think that number A is her best way to do things.
Yeah. Do we have anything in the chat? Wells Fargo disabled the chat. I can't see it, so you guys are gonna have to tell me.
So Daryl, is there anything in the chat? Because I can't see it because I'm sharing my screen.
Nope, nothing in chat.
Teamwork. Okay.
Nobody
So
has an answer? Somebody must have an answer for this. Is it A?
B?
We do. Tyler says number 1.
Tyler says A. Okay, what about anybody else? Does everybody agree with Tyler?
Giselle says number 3. Sudan says number 3. Majesty says number 3. So wow, a lot of people say number 3.
Should we
Oh,
go with number? I mean, they're all good choices. So should we go with number 3 and see what they say?
All right, let's see. You are correct. Everybody who said number 3 is correct.
Good job.
Good
Awesome.
job.
And I think it'll give us so awesome advice. Good job, you guys, making savings automatic and saving as much as you can at the best interest rate you can find is a great strategy for building wealth and strong financial future. And I'm having a hard time reading that. Randy earns more over time. She should increase the amount she saves. So they're saying that as she gets a raise, earns more money, she can increase the amount she puts into saving. And to earn more interest on your savings, shop for a savings account with the highest annual percentage yield. So we're getting into some technical terms, the APY. You can find, there's another article that we can send that talks about what the annual percentage yield is, but basically it's how much you can earn on your money over time. So again, the bank paying you money to keep your money in their account. So good job. And go ahead and play the next All About Savings.
You probably like making money and spending money, but how do you feel about saving money? Maybe it sounds boring or even painful, but in reality, it's not.
I agree. Think of saving as giving a gift or paying a reward to you. The money you save gives you so many benefits, like cash in an emergency, and the ability to buy big things, like a car.
The thing to remember is that building up huge amounts won't happen overnight, but it will happen if you make it a habit, make it automatic, and stick with it over time.
Right. Thank you. So I think that there's a couple things that they said in there that, making it a habit, making it automatic, and being patient, that it takes time for your money to grow. And, if you think about a habit, like if maybe you take up running, they say that if you do it consistently every day, it's going to come easier to you, and it's going to be something that you don't think about, that you'll just automatically do it. So that's when you're thinking about making things a habit, you just keep consistently doing it over and over again, and making it automatic. When you start working, or if you are working and you have an employer who will do what's called direct deposit, where on payday they will automatically deposit the money into your checking or savings account. If you designate a certain amount of that specifically for the savings account, say your paycheck gets deposited into your checking account, and you take a certain amount and just deposit it into your savings account first, right off the bat, that's one way that it's going to go in there, and then you'll have the rest of your money to pay your bills. But just make it automatic, make it as easy as possible. And when you go into the bank or the credit union to talk about opening your savings account, ask them about options that you have for an app that's on your phone, or what's the easiest way to make this. Tell them exactly what you want, and they will walk you through the steps to help you achieve what you want to achieve, to make it automatic. So if we go down a little bit, we're going to talk about some of the things, and I think I already mentioned this, about what the ways that savings account can benefit you. So it keeps your money safe, grows, your money grows or gets larger with interest. You're prepared for the unexpected expenses. You can make purchases, and you can help achieve the goals. So if it's, you want to buy a car, you want to buy a business when you graduate from high school, you want to go to college, you want to get your master's or your doctorate in whatever you're studying. Those are all your major life goals, and this is the beginning of saving so that you can help meet that goal. We talked about interest. Again, interest is basically the money that the bank pays you for putting your money in the bank. And the amount of interest you earn depends on 3 factors. And one is the interest rate. 2 is how long you keep your money in the account, and then how the bank pays the interest. So and they have it right here in the slide, almost all banks compound interest. And so what is compounding interest? Basically, it means that the bank will pay you an interest rate, and then the following month, they pay you for your total amount that's in your account. So to make it simple, let's say you have $10 in your account, and the bank pays you 5 cents for 1 month for keeping it in that account. The next month, they'll pay interest on $10.05. And it just keeps growing and growing and growing. And banks usually pay interest either quarterly, they can pay it monthly, quarterly, 6 months. It just depends on the account that you sign up for. So that's a question that you should ask when you open your savings account too, is what's the interest rate and how often do you pay interest to me? And you will get a statement at the end of the year from your bank that tells you how much interest they paid you over the year. And it's also something that they usually show on your statement as well, that you get.
So can I interrupt,
That's very,
Jane? Let me ask the audience, how many people have had in high school, particularly, what Jane just talked about? Can anybody tell me, did you have what Jane just talked about in high school? Nobody? All right, so I'm gonna give you a 2-second, maybe a 2-minute class. Your initial money is called, and I want you to write this down because again, I want you to have these conversations with your parents. Your $10 that Jane just talked about is called principal. That is the initial amount of money that you put into your savings account. The interest rate that Jane said, ask the bank how much they're going to give you in interest, is called the rate. And the effect of that rate to the principal is called time. Okay? Okay? So it's principal times rate times time. And when you compound that, you're compounding that formula times the current rate. That's called compounding. Now, that might sound difficult, but let me put it to you in an easier way. We all have a cousin, brother, uncle who may want to borrow $50. We give the cousin, brother, uncle $50, and Lord knows we're happy to see that $50 at the end of the week, end of the month. More than likely, we never see it again in life. But when we get our money back, it's $50. And you're happy to get the $50 back. But let me ask you a question. If you lent somebody $5 million, do you want the $5 million back? No. You want the $5 million plus interest because you could have put that $5 million in the bank and collected interest from the bank. So I want you to understand the value of money and also how money is calculated. So I'm hoping that you wrote down principal times rate times time. And another way to put it is PRT. And the reason why I asked you guys if you had it in high school, I had it in high school, but I didn't have computers in high school. You guys are way more advanced than I am, but I wanted to show you the evolution of education. So some things have been dropped out because you guys are more on computers and so forth and so on. Okay, Jane.
Okay, well,
Yeah.
I want to say one thing right now. We are in COVID. So if you have a savings account right now and you go online and look at your account or you pull out your monthly statement, you might say, I'm not making a lot of money right now. Like I'm not making a lot of money at all. That's because we're in COVID. And so because we're in this pandemic, you're not making as much money on your savings account as you would if we weren't in COVID. So don't fret. I mean, I look at my bank accounts every day and I laugh because I made 5 cents last month off one of my savings account. And I'm like, 5 cents on the amount of money I have in the bank, I only made 5 cents because we're in crisis right now. And we don't have a great interest rate. The interest rate is extremely low. Now, when we come out of COVID, I'll go back and I'll make, 3%, or 5% or whatever bank you bank with. It's a different percentage you will make on your money in the savings account. And then I'll see my savings really start to blossom. But right now it's not blossoming. It's just standing still. So I just wanted to remind you of that when you look at your bank statement.
Right, right. Thanks, Rhonda. I mean, that's important. And the thing is that your money is safe too. It may not be growing a ton, but it's safe and it is growing a little bit. And Rhonda talking about the COVID and that we're in a time of emergency, banks pay interest. The amount they pay you for having your money in their account is dependent sometimes on the economy. So when the economy is having a rough patch like we are right now, a lot of people are losing their jobs, and the rates that the banks are paying are going to be a little bit lower. And as the economy turns around and they're able to, the banks are able to pay you more, they will. So, at the beginning of the lesson, they talked about savings, make it a habit, make it automatic, and to stick with it over time. So that's the time might be the hardest thing, but just stick with it and it'll pay off in the long run. So
Well,
in here,
let me connect the dots on what Rhonda and Jane are saying also. Again, and I'm asking you guys to write this down, and young ladies to write this down. There's a cost to money. There is a cost to money. Just like I said, if you get that $50 back from your uncle, cousin, you're happy. But you would not give out $5 million without charging somebody a cost, and that's interest. The federal government, now I'm getting a little heavy, the federal government gives money to the banks at a cost. And like Rhonda said, that cost is very low right now because the money that the banks give to the people has to be low because of COVID and the loss of jobs. The cost of money from the federal government to the banks, and I'm going to just use an analogy, might be 0.5%. Ask your parents how much they're paying on a car loan. The difference between what the federal government is charging and what the banks are charging the car loan is a profit to the bank. So I want you to understand the flow of money. And it's a little bit more complicated than what I said, but I'm trying to keep it simple.
yeah, it is complicated. Thank you, Daryl. Yeah, thank you for that. And you know, again, you might have, as you have questions, you can put them in the chat too, or follow up, you know, next week you could ask some questions about this too. But let's look at an actual example. So on the screen right there, this is talking about, again, showing you the power of this interest and the compound interest. So on the chart, you see if you saved $5 a day with no interest, how your money would grow. So year one, you know, you're at $1,825, and in 10 years, you've saved some money. You know, year 5, you're at $9,000. Year 10, you're at 18. Year 30, you're at 54,000. But if you save that same $5 a day at 5% interest and it's compounded daily, then it shows you how your money grows. So year 1, you'll get $46 more. And that's basically, I mean, that's, again, the bank's paying you for having your money in the bank. Year 5 looks like $1,241 more. Year 10, you get $5,427 more. And year 30, look at that. So that, again, this is the talking about sticking with it over time. In 30 years, you'll have accumulated $72,000 more. So your $1,871 in year 30 is $127,077. So it's just shows you what, you know, it's important to ask when you open that savings account, what is the interest rate that you're going to be getting, and to understand that that is going to benefit you in the long run. So any questions about that or any comments? Okay. Rhonda, would you mind scrolling down? Okay, so tips for saving more money. So, you know, would love to hear what you guys think. Maybe you've done some of these things as you spend your money, earn your money and spend it. So, you know, please feel free to jump in or to maybe add to it in the chat. But the first thing is, do you want it or do you need it? So give some thought to the items that you're going to buy, and maybe set some rules. Keep track, you know, of what you spend to see what you can maybe cut out, so that you can save that money. But when you're buying something, it's really easy to get caught up in the excitement of, oh my gosh, I got to have these new shoes. They're awesome. Or I need, you know, I need this new hoodie or whatever it is. But really step back and say, do I really need this, or is it just something I want? And what I've done, one thing that I do is if it's something that costs a lot of money that I didn't have in my spending plan, I will make myself wait 24 hours before I buy it. So I will leave the store and go back the next day if I really want it. And it just makes me stop and think about it. So Really think if it's something you want or that you need to have. The second thing is, like we've talked about before, make it a savings an automatic habit. So just put a portion in your savings account each paycheck, and it can be any amount. No amount is too small. Third thing, pay yourself first. I think we've already kind of covered that. Reward yourself for the hard work that you put in there. And then fourth thing, set aside any extra money that you get into savings. So if you get money for birthday or Christmas or a tax refund, put as much of that in your savings account as you can so that it'll be there if you have an emergency or if you want to buy something in the future. If you're saving for a car or saving for college, it'll be there in the future. The next thing is pay your bills on time. So you may not have a lot of bills right now. Your parents maybe do. You could ask them about, how do you pay bills? But always pay your bills on time. If you pay your bills late, so like your cell phone, bills that your parents also pay are maybe their mortgage, the electricity, the heat, the gas, maybe they have a car payment. Those are all things, unless they've paid them off already, they have to pay them on a monthly basis. And if you don't pay it on time, you could get a late fee. Your interest rate could be jacked up. Maybe it's your car loan is at 6% interest. And if you pay your bill late, it may go up to 9%. And that is a larger payment then that you haven't budgeted. But it can also get into things like your phone maybe will get disconnected. And sometimes with rent and mortgage, there may come a point where they will evict you, which right now they can't because of COVID. But anyway, that's just something to think about. Another thing about paying your bills on time, some of your creditors do report to what's called a credit reporting agency. And this is basically a report card on how you've paid your bills. And it will impact you if there's a lot of negative. So if you've gotten some late fees, if this is reported on your credit report, it may cost you more in the future when you take out a loan for a car, or it may impact you when you're looking for your first apartment. So paying your bills on time is really super important. We can't emphasize that enough. Rhonda, do you have any personal experience you'd want to talk about in that?
Yes, I do.
Okay.
Yes. Jane is absolutely correct. You have to pay your bills on time, even if it's your cell phone bill. Now granted, you may not have a lot of bills right now because you're in high school, junior high and high school. So we understand. But when you get a bill, you may have your cell phone bill, or your bill may be part of your parents' bill. But if you have a bill on your own, whether it's a cell phone bill or whatever, automatically pay it on time, because Jane is right. When you have credit with a business, they report to the credit bureaus if you pay it on time. And you want to pay on time so that when you graduate from college and you're ready to get, you're ready to get your first apartment, or you're ready to buy your first home, where you need an extensive, when it comes to an apartment, you need to have good credit to get the apartment. So they're going to pull your credit report and say, hey, Rhonda pays her bills on time. She pays AT&T. She pays NV Energy. She pays all these people. Oh, she pays on time. She's great. She's not a credit risk at all. We'll give her the apartment. Now, when it's time for me to get my house, because I want you to start thinking about this, because this is something that I didn't do, but I want you to start thinking about it. When I graduated from college, I made a lot of money and I blew it on things that meant nothing. I should have bought a house. I know that sounds crazy, but I have friends who at 22 years old bought houses, not big, fabulous ones, but small ones. But they bought a house because that helps their credit. That is a piece of property. Once you get, or condo, you can get a condo or a townhouse, whatever it is, buy your first piece of property early. But anyway, I digress. And the reason why is because when you go to buy something big like property, or you go to buy a car, which is very important, they pull your credit and they determine what interest rate you're going to get. So if you have good credit, you get a low interest rate. If you have bad credit, they give you a high interest rate. You don't want a high interest rate. You want to look good to the banks. You want to be like, I want Jane to say, Rhonda looks good on paper. She pays all her bills on time. Great. I'm going to give her a low interest rate for her car loan, because that's probably the first thing you might buy is a car. So you want a low interest rate. You don't want a big interest rate, right? So if I buy a car for $15,000 I want a low interest rate, 2, 3, 4%. Then my monthly payment is something doable. But however, if I have bad credit and I buy that same car at $15,000, my interest rate might be 15 or 20%. And my payment may be something crazy. My car note might be $500 a month, on a $15,000 car. That's absolutely ridiculous. When you buy a $15,000 car with good credit, your car note could be $250 a month, right? Because you have to remember, when you're doing your budgets, you want a low car note, right? Because that's the first thing you'll buy. And then you have to buy insurance for the car. So you also have to have good credit to have insurance. The insurance people pull your credit as well. And they go, oh, Rhonda, her credit's great. Great, we'll give her a low rate. You know what I mean? Or you may put your car under your parents' insurance. For the first car, you may go up under your parents' insurance because they may get a better rate, right? Because you want to keep your monthly bills low. When you're a young person and you graduate from school, or you go to trade school, whatever you do after you leave high school, you want to keep your monthly bills low, but certain things you have to have. And for transportation purposes, you have to have a car, which means you have to have car insurance, which means you have to have good credit so you can get a lower interest rate. Okay, enough right now.
But thank you. I mean, exactly. And I know that next week's lesson is going to be on credit, so you will have time to get into the details and discuss this again. But it's super important to pay your bills on time. So we will get into to credit. We also, later on in this lesson, we're going to talk about buying, we'll touch on buying real estate and buying a house. And that is one way that you build your wealth and one way that you build your assets. And those are also things that can help you reach some of your financial goals. So maybe you can retire earlier than I know that I'm going to be able to retire. So just things to start thinking about. It may seem like it's a long way off, but really it's not. And you do need to just start thinking about that. So ask your parents, how they decided to buy their first house, or what they had to go through to get their first car, and the insurance. And there's so many components that go into all that. So, it's definitely things to think about. The last two items on this list: avoid check cashing stores. So check cashing stores are the handy dandy. Maybe they're, you can bring in, get an advance on your paycheck if you need, but check cashing stores are an option if you don't have a bank account. The thing you need to know about that is they do charge you fees to cash your check. And usually they're pretty high fees. So that's another advantage to having either a checking or a savings account with a bank or a credit union, is that they may charge you a monthly fee for your overall account. They often have zero fees for students. So because you're a student, the checking or savings account that you get, or both, it should be without any fees at all. So that's an important thing to ask when you go in to open a checking or savings account, is ask about those fees. So there are options at most institutions. But at the check cashing stores, there's not an option. They will just charge you money just to cash your check. So that can add up. If you go in every month and they charge you $10 over the course of a year, that's $120. And I don't know about you guys, but I can use $120 to either put in my savings account or spend it on something that I want to spend on for me. So that's one thing to think about. And then the last thing is saving for retirement. And again, you guys are in high school, but if you're working your first job, or when you start working your first job, because you will, there may be an option to save for retirement through your company. So make sure that you take advantage of that. It can come right out of your paycheck. And if your company doesn't have a retirement plan, talk to your banker. They have people there that can help you with that. And if you start young, it's going to be easier to build up your retirement account and help you retire sooner, if that's what you want. So any questions about any of that, or any thoughts from anyone? Okay. Rhonda, you want to go to the next lesson, the investing basics.
Putting money in a savings account is one way to make it grow. Investing is another.
The main idea behind investing is to put money you've saved into things you think will go up in value over time. Things like stocks or bonds or real estate. The trick is to buy when the price is low, then try to sell when the price is high. That's how you make a profit.
One big difference between saving and investing is that investing always involves risk. If the value of your investment goes up, you could earn more money than you would in a savings account. But if the value goes down, you could lose some or even all of your money. That's why you should never invest money that you can't afford to lose.
And that's why before you invest, we want to make sure you know the basics of what investing's all about and how it works.
Great. Thank you. So savings versus investing. These are, I'm just going to read through these. They both help you build your wealth. So they both help you reach some of your goals that you want when it comes to handling your money. But there are some differences that you guys need to remember and be aware of. So when it comes to savings, a savings account is typically for smaller, shorter term goals in the near future, maybe 3 years or later. And so like going on a vacation, having money for an emergency. With savings account, you can easily access your cash. So you know, it's something that you can get from an ATM, you can get directly from the branch. You don't have to wait any amount of time. Some accounts, though, you can only withdraw money, say 5 times a month. So that's an important question to ask when you open your savings account. So you make sure you understand that. Also, minimal risk. There's no risk really for that you would lose your money at all with savings account. You know, if anything, we've talked about the interest, and you'll be making money on your money. And interest, again, making money on your money, you're earning interest. And it is a lower return than investing is, and you'll see that, but you are still earning interest. So Rhonda, if you want to click on the investing tab. So this is the difference with investing too. Investing is longer term. It helps you achieve major goals. And there's different accounts when it comes to investing that you have the choice of. And we'll get into that in just a minute. But again, it's usually longer term to achieve major goals. Buying a house would be one thing, retiring, which we've talked about, is another. It's harder to get this cash. And part of that is because they do, usually it pays, either it's a higher interest rate or just the investment itself is just harder to take the cash out of. Maybe there's a term on how long your money has to stay in there. It always involves risks. So the risk is you could lose, there's no guarantee that you're going to get your initial investment back. So Daryl spoke earlier about your initial deposit in your savings account is the principal. That's what we're talking about, is you may lose all the money that you put into this investment. But the potential for profit is going to be higher than a regular savings account. The investments, because you're putting your money in there for a longer period of time, you're going to be able to earn more money. And so that's one thing, is that you've got the opportunity to earn more money on your money. So Rhonda, if you want to go down a little bit, I think they get into some of the different types of investments. Yeah, they sure do. So we can read through this. The first one is low risk investments. And these enable you to earn interest on your money while maintaining some liquidity. So it's flexible, but it's not as flexible as a savings account, if that makes sense. The odds of losing your money through these type of investments are extremely low, but they also have lower return than some of the other investments that you see listed there. So this is a low risk. And some of the common examples, which are coming up next, are the certificates of deposit and the money market deposit account. And, you know, these type of investments, when it comes to investments at the bank, we have people that are specially trained to talk to you about these type of investments, because they can get kind of complicated. So in this lesson, we're just giving you the basics. It is something, though, to ask when you go into your bank, when you're at this point of your savings and your financial plan, to ask about the differences between each one of these accounts, and they will give you more details. But certificates of deposit, you may have heard about these because they're kind of common. They have a low risk investment. And the amount that you're required to invest depends again on the bank that you're going to and what options they have, but usually it's just a lower initial deposit. So $1,000 is what they have as an example here. And with a certificate of deposit, you just agree that you're not going to pull that money out for a certain period of time. And it could be anywhere, usually it's at least 3 months, 6 months, 9 months, 12 months. With the longer you keep your money in this account, the more interest that you usually earn from it. So that's a certificate of deposit. If you go to the money market deposit account, so this is also a low risk investment, and it's a form of a savings account, but it requires a larger deposit than the first two, and usually at about $10,000 or more. And again, it's you get a better rate. You're investing more money in it, and you're still leaving it in there for quite a long period of time. I'm going to stop and see if anybody has questions, or Daryl or Rhonda, if you have anything that you want to add with any of the low risk investments.
Unmute
Daryl, there you. Sorry.
All I want you young people to understand is money works with time. So when you have a conversation with your parents, when you have a conversation with the banker, find out how much time is going to go by before you have access to your money. It's very important. And with that time, find out what the interest rate you'll receive for utilizing your money. And that's why I said to you earlier, pay attention to what your interest is on a car loan. Okay, you're borrowing money from a bank, and the bank is charging you for that car loan. Find out what the interest rate is on a house. Okay, so understand money works with time, and there's a cost for money. Okay, that's it.
Perfect. Rhonda, did you have anything?
They're both absolutely correct. You have to be patient with the money. If you decide to open up a certificate of deposit or a money market account, that's great. It's money that's working for you, and in the long run, you'll have more money. That's it.
Perfect, perfect. Okay, let's keep going. So stocks is the next option. And you guys probably heard of the stocks and the stock markets, but this is basically when you invest in a business. So buying stocks gives you part ownership in a company, and that's why you should only buy stocks from companies that you believe in. So there are, and when you buy a stock, and I think, Rhonda, if you want to toggle forward, it gets into shares. When you buy a stock, you become a shareholder of that company. So for example, Wells Fargo, we have a ton of shareholders, and they basically invested money in Wells Fargo, and then we pay them. And it depends. There's a lot of complications and lots of components that go into how much we pay on our shares, but we do pay people for investing in us. So if at the shares and the dividends, that's what the stocks that are usually bought and sold in units are called shares. A share's value or share price rises and falls based on how much people will pay for a share. People will pay money for the stock if they think the company will be successful. If it is a stock, an increase in value, sometimes the company will also pay its investors a dividend, and that's when the company pays the shareholders a part of its profit. So just speaking of Wells Fargo, for example, every quarter we pay our shareholders a dividend. It may not be very much, but it is something. So I think because I do own some Wells Fargo shares, because my company is Wells Fargo and they let me buy shares, I got a check this quarter for $3.30, and it is going right into my savings account. So you do get paid for that. The next option is mutual funds.
One second, Jane.
Yeah.
If you could maintain that screen there, Rhonda. Third line down, it says for the stock, if they think. That word think is a very important word. Stocks move based on perception.
Mhm.
Okay? They move based on the company's results, but they also move on what people think the company's going to do in the future.
Mhm.
So understand the risk involved in buying a stock, because there's a difference between the results and what I think the company will earn in the future.
Mhm.
Case in point is Amazon. I don't know what the shares are going for, look it up. But once upon a time, it probably was trading for $1. And now I think it's $1,500. Google. Google probably came out at $10. Now it's $3,000. Because as Jane said, as an investor, I think this company is going to grow.
Thank you. And again, to remember with investments, especially when you're talking about the stock market, there is no guarantee that there's the real possibility that a company may tank and you may lose all your money on it. So there's no guarantee that it will go up, but Daryl hit it right on the head. The perception, often with stocks, people want to get in at the low price and then sell it at a high price if that's what your plan is. And again, banks, financial institutions have people that this is their entire job. They spend all day looking at things like this to help gather all the information and help you make good financial decisions when it comes to your investments like this. So again, this is something usually you get into as you get older and you start accumulating wealth and accumulating assets, but it's something to keep in mind and to ask about. And it also, these are pieces of retirement funds as well. So good points, Daryl.
Let me bring up another example that some of you youngsters, because again, I'm not technical savvy. Rhonda is way more technical savvy than I am. But there is a product out there called Bitcoin. I remember Bitcoin coming out at $100, and Bitcoin is basically a way of exchanging goods, just like the dollar is. I don't know about it. I don't know how it works, but it's out there. I remember when it was $100. Right now, it's trading at $48,000. So I'll be gone from this life, but you'll be here in this life, and you'll either be affected by a Bitcoin or not. But I just want you to understand, when it came on board, I remember it being $100. Now it's $48,000.
Yeah. And Bitcoin is definitely, it's confusing. I don't understand it. My husband has some Bitcoin, but it's electronic currency. So yeah,
That's why I
something
didn't
new.
want to get into it. I'm just letting
Right.
them know that
It's out there.
based on perception, and right now they think, a lot of people think it's the future of trade, and now it's trading at $48,000.
Mhm. Yeah. And who knows what it'll do in 6 months, a year.
Right.
That's the risk.
And
piece.
like Jane says, if Bitcoin is never used, never, ever, ever used, people buying this for $48,000 potentially could lose their money.
Right. Exactly. A quick time check. We've got like 15 more minutes. Do we have enough time to keep going in detail on these? Okay.
Students, if you don't mind, we're going to go a little over today because we want to finish this section and to make sure you understand it. So we're going to go a little over today, everybody. So please
There's a
stay
lot
on
in
with
here.
us.
Thank you. So if you wouldn't mind going to the mutual funds tab. So mutual funds is another way to invest your money. And basically it's a fund that's professionally managed, a collection of money from a group of investors. So instead of deciding for yourself what stocks or bonds to buy, a mutual fund manager makes these decisions for everyone on the group, deciding what to buy or sell and when. And some mutual funds will be higher risk than others, and no mutual fund is a sure thing. So again, the risk piece of that, So the thing that's important is you have a mutual fund manager who makes decisions for you and your investments, and as well as other investors. The important thing about that is to have a really detailed conversation with your mutual fund manager. Make sure that person understands how much risk you want to take and what type of companies you want to invest in. And as you're having that conversation, if you don't feel comfortable with that person, probably wouldn't want them to manage your money. So that is one type of investment. And I guess probably, Rhonda, if you go into the next tab, the risk versus reward, I probably already, yeah, because a mutual fund invests in a variety of stocks, bonds, and other products, there is usually greater potential reward than many low risk investments and less risk than buying individual stocks and some bonds. And the additional thing about this is that they have the time to do research on the companies, and you don't have to do that as well, but you still have to have very detailed conversations with your mutual fund manager to make sure they're investing your money the way you want them to. So the next one is bonds. Right, bonds. So corporations, governments, municipalities, which are cities, issue bonds to raise funds, and they raise funds for things like building schools or doing road repair. In return, they typically repay the bond owners with interest. In this way, a bond is like a loan. When you purchase a bond, you are lending money to a corporation or to the government for a certain period of time called a term. And the terms are usually pretty long. They could be 10 years, 15 years, 30 years. The bond certificate is a promise from the corporation or the government that they will repay you on a specific date, usually with a fixed rate of interest. So let's just say that you purchase a bond for $10,000 for the city for Las Vegas. And in 20 years from now, they're going to pay you back that $10,000 plus an additional $5,000. And that helps the cities, the government, and the corporations finance things that need to be done right now. And so for you, those are pretty safe. That's usually a pretty safe investment. But I'm not an investment manager, so there are still risks involved with it. Let's go down to Rhonda, I think, do you want to go back up to that? I think there was one more tab that talks about real estate. If we could just do that. Click on the bonds.
Oh,
I know.
okay.
Let's go to real estate and talk about that. So real estate. So this would be like buying your own home, or maybe buying a rental property, maybe buying commercial property, things that maybe your parents do right now, or things that you should think about as you get older. But many people invest in real estate, such as a home or property. One positive aspect to investing in real estate is that it usually increases in value over time without the daily ups and downs that happens in the stock market. Like stocks, you earn money when you sell your real estate for more than what you paid for it. Keep in mind, again, it can take time to sell a home or property, and that there are costs involved in buying, selling, and owning real estate. So, I mean, if you look at the Las Vegas market, when it comes to buying a home, I know back in 2009 there was a crash, but I think that the home prices have steadily increased. So you may know people who maybe bought a house for $100,000 5 years ago, and today they're able to sell it for $125,000. So that's the profit when they're talking about that the real estate increases in price. It could go down, and depending on what's going on in the economy, or maybe what's going on in that particular city. But it is something that you should think about. And again, it's a way to build your wealth and to have an asset as you get older. I don't know, Rhonda, Daryl, do you have anything to add when it comes to owning property?
Yeah, in a nutshell, young people, write this word down: risk. Assess the amount of risk you're willing to take. Time. How much time do you want to return on your money? And diversify. Diversify where you put your money. Ms. Jane talked about stocks, mutual funds, bonds, real estate. Spread your money out. So if one of those markets decrease, you have monies in other markets. As Ms. Jane talked about in 2009, the real estate market collapsed, okay? As an investor, I lost my money in real estate. But if I was in Amazon, if I had 50 cents in real estate and 50 cents in Amazon, my 50 cents in Amazon would be growing while my real estate would be going down. So again, I beg you, not ask you, I beg you to talk to your parents about risk, time, and the cost of money.
Perfect.
And real estate, I mentioned earlier about the real estate, how my recommendation to you is that once you graduate college, right after that, you buy your first piece of property, whether it's a condo, a townhouse, a townhome, or a small house. And the reason why I say that is because when I graduated from college and got my first job, I think the first year I made, a little bit of money, but as I grew in my career, I made a lot of money. And from age 24 to 30, I made a whole lot of money, and I used it buying clothes and traveling and doing a lot of stuff. And don't get me wrong, you should enjoy your money. So don't get me wrong, you should buy yourself some things. But I thought about it when I turned 30. I said to myself, I've made a lot of money over the last 5 years, and I have nothing to show for it, and I have no tax breaks because I didn't have any kids. So I'm like Uncle Sam is taxing me to death because I'm single and I make a lot of money and I have no kids, I have no property, I have nothing. So at 30 years old, I bought my first 1-bedroom condo. And so when you buy yourself a piece of property, it's like you're paying yourself, right? So I lived in high price apartments. I paid people thousands of dollars a month, living in apartments, right? Which is great because I live in an apartment, people have to live in an apartment for once or twice in their life. But when you buy your condo, you're paying yourself. You're paying your mortgage every month. You're strengthening your credit, and you get a tax write-off at the end. So the same amount of money, the same $1,200 a month rent, I was paying an apartment complex, I went and got the same 1-bedroom condo and paid $500 a month, right? My mortgage, my first mortgage was $500 a month, but I was paying $1,200 a month for rent. So when you look at it, you're like, wait a minute. I'm making more money or keeping more of my money by getting a mortgage. So that's called money management. That's called money budgeting. You look at what you're bringing in, you look at what's going out, and you look at what you have to save. So by me going into a 1-bedroom condo, it allowed me to save money. So that extra $700 I could put in a savings account and use that, for my retirement one day when I retire. But I'll probably never retire, but that's another conversation. Okay.
And you know what? I did the exact same thing as you did, Rhonda. When I graduated from college, I was renting and spent my money on lots of things that were out of style in a year. And at age 30, bought my first house, very small house, but it was the best decision that I made. And there's lots of decisions to go into buying a home too, which maybe, I don't know if we have that on the schedule, but we have people at the bank who that's all they do all day long is give mortgage loans out and make those decisions. And they are people that you can talk to. Lots of resources out there, which we can't get into today. So we'll keep on the lesson here. Rhonda, would you mind?
One second, Jane. One of the things that I want you young people to get from Rhonda's story and Jane's story and my story, again, we were young once. We made mistakes. Please learn from them. Okay? Take notes, take mental notes. Okay?
So now some savvy students, for some savvy students to go to college, they're buying houses now and they're getting roommates to help them pay their mortgage. So they're buying houses at 19 or 20 because they have a job, and then they get a small house and 2 or 3 students live there together and that person pays their mortgage. So they're even buying, so young people are buying houses earlier now, and then some of those students, after they graduate from college, they still rent those houses out to other college students. So that's an asset. That's a piece of property you purchased when you were in college before you even got out and got your real full-time job. So just think about those little things when you're thinking about moving forward.
You know, it would be worth having a conversation after everybody completes these classes, maybe having a special just discussion on, you know, on home buying and things to look out for. So that's something we could do too. So we've just got a couple more things to touch on, but one thing that we want to touch on is inflation and what inflation is and why it impacts you and why should you even care about this. But you probably noticed that price for things, it fluctuates, but it seems like often prices tend to increase and go up over the years. So what that is when the general price level of goods and services goes up, that means the purchasing power of your dollar goes down. It's called inflation. And it can really eat away at your future purchasing power. So for example, they have an example listed here. If you took $1,000 and you put it in a box and left it there for 25 years, assuming an inflation rate of about 4%, when you took the money out at the end of the 25 years, you would only be able to purchase about $368 worth of goods. And that graph there shows how inflation works and the different inflation rates that come about. And so the reason why this is important to understand, it's important to understand that if your money isn't growing at a rate at least equal to the rate of inflation, you're losing money. So when you talk to people about your savings and your investments, try to make sure that your money is always growing at a higher rate than the rate of inflation. Saving and investing money can help you do that. And it's not always easy because depending on the economy, that impacts the inflation rate as well. The one thing to remember is that it takes time. All of your investing and your savings to reap that reward at the end of the tunnel, it's going to take some time. It's not going to happen overnight. So just remember that. Okay.
So if I can add to that, a simple math scenario, when you get a raise and your employer says you're getting a raise for 3%, ask yourself, like Ms. Jane is saying, what is inflation running? If inflation is running at 1%, you're really getting a raise at 2% because you're covering inflation and you got a 2% raise. So simple math, but like Ms. Jane is saying, we want you to have inflation in your conversation and in your language.
Perfect. Thank you.
Mm-hmm.
All right, Rhonda, I think we've just got a couple more. Again, compounding. So I think other things to take away is we're going to talk about compounding again, the compound interest, but compounding occurs when your earnings on an investment are added to the amount you originally invested. So again, that principal in the savings account, your initial investment in an investment, as you earn interest on that interest is added to that initial investment. And it'll help your total investment to grow larger. Your earnings have the potential to grow larger too. How fast an investment grows over time depends on the rate of return you earn each year. So again, we talked about it already, but that's why having compounded interest is important, and that's how it helps you increase your savings at a faster rate.
Can we, Rhonda, can we stop right here and pick up this spot right here next week?
Yes, we can.
Okay, because Rule 72 is very important, and I would not like Ms. Jane to have to rush through it because we're running out of time.
Okay.
So if everybody could write in their notes that we stopped at lesson 4, Rule 72, because I'll forget, I would appreciate it.
I'm writing it down.
What we'll do is we'll try to speed up and catch up next week. Because we're going to talk about credit. And we've talked about a little bit about credit this week. So we may not have to repeat ourselves as much.
Right, exactly.
Yes.
And part of that's the tech side. I didn't realize that we were doing the lesson, so thank you for that. And so just really quick, I mean, things to think about is that savings is basically paying yourself for your hard work. So keep that in mind, that you want to reward yourself. Your work is important and you should reward yourself. Saving is easier if you make it a habit, if you make it automatic each time you get a paycheck or a gift, and then just stick with it over time. Don't give up, and ask your parents about what their savings plan is, or how as a family you all can save together. But as you continue to get older, look at the money you're earning, figure out how you can save it, set goals, and just be patient, and it'll pay off. So if there's questions, I'm happy to answer them. Or Rhonda, Daryl, I'm sure you've got some additional thoughts and next steps.
No, Rhonda?
Yes. So everybody think about what we learned today. Although we didn't finish the chapter, I still would like for you to take the assessment. So over in the chat, it is a link to the assessment. Please take the assessment while we're on, and then once you finish, send me a note in the chat letting me know that you have completed the assessment. And then, like Daryl said, we're going to pick up where we left off last week, because we touched a little bit on credit and stuff today. It won't be a long call, but we'll pick up where we left off, because Rule 72 and everything after that is extremely important. Do we have any questions from the students? Let's open up the floor. Are there any questions?
Okay.
No question?
Again, I know I'm sounding like a broken record. Please take this information, think about it, understand there's value to it, and talk to your parents, please.
Yes. Yes. Okay, so once you finish the survey and you've sent me a note saying you finished the survey, you may exit, and we will see you next week. And don't forget, I need you to come on early because we start class at 10 a.m. So if you could come on at about 9:55, that would be great, because we want to start class at 10, because I take roll call at 10, and I want to make sure that I have your name down on the attendance list so that we can move forward in the program. And that's one of the qualifications also to redeem your money that you're going to make, that you're going to get from us at the end to match your dollars in the bank. So we want to make sure everybody is here and everybody's accounted for so they meet the criteria. Okie dokie.
Perfect. Perfect.
All righty.
Thank you. Good luck with your week, everyone. Have a good week in school.
Are you getting everybody, Rhonda?
They are letting me know when they're complete. Yep. I'm waiting for everybody to complete it before I shut down.
But you can't tell if they completed.
I'm going to find out. I usually call headquarters. I send them an email on Monday and they give me a list, so I know who completed it or not.
Okay.
So Tyler, I see a note. So Tyler, if you just click in the chat, Tyler, if you just click that link, it should take you right there to take the assessment. Cut on your microphone, Tyler, and tell me what problem you're having.
Hello?
Hi.
Oh, you can hear me from this? All
I
right,
can.
All right. So basically, I click on the thing, right?
Mm-hmm.
I'm trying to log into my account so that I can actually go on to it.
Mm-hmm.
So, yeah.
So when you say log on to your account, you set up an account with the program?
I guess.
You don't have to
So,
have. So basically, when you double click this link, it should take you directly to the assessment. Let me double click it.
Okay, hold on.
If you double click it, it should take you directly to the test. I don't think you need to sign in or do anything.
Okay, yeah, okay, yeah.
Okay,
I got it.
right? So you're there, right?
Yeah.
Okay,
Yeah,
great.
yeah, I'm
So-
gonna do this real quick.
okay,
Yeah, it
fantastic.
should be fast. I already got my notes and stuff, so it should be pretty fast.
Okay, great. Fantastic.
And Rhonda, you're sending them the lesson plan before we meet on Saturday anyway.
Correct. So they have a chance to read through it on their own, and then we go through it
Right,
and answer any questions.
right. And you have these in recording?
Yes.
Okay.
We record each session.
Okay. I forget. Sometimes I hit record. That's what I'm asking you.
So they have it set up where it automatically records when we come on. So when I
Okay.
open up at 9:45, it starts recording.
Oh, okay. Okay.
Okay, Tyler's done, so we're all done. Okay, thank you, Daryl. Great class today. And enjoy the rest of your Saturday.
I'll talk to you. Thanks.
Okay, bye-bye.